Welcome to SS2 Agricultural Science, Term 3, Week 13. Agricultural insurance is a risk management tool that protects farmers against financial losses arising from crop failure, livestock death, equipment breakdown, or other farm-related risks. Farming is an inherently risky enterprise, and in a country like Nigeria where most farmers are smallholders with limited savings, a single bad season can push a family into poverty. By the end of this lesson, you will define agricultural insurance and explain why it is important, identify the types of agricultural risks that insurance can cover, describe the types of agricultural insurance products, evaluate the challenges of agricultural insurance in Nigeria, and explain current government and private sector initiatives in agricultural insurance. Let us begin. What is insurance? Insurance is a financial arrangement in which an individual or organization pays regular small premiums to an insurance company. In return, the insurer agrees to pay compensation if a specific loss or damage occurs. The principle, pooling of risk among many policyholders, the losses of the few are paid from the premiums collected from the many. Agricultural risks. Farming faces multiple types of risk: production risks or on-farm weather risks, drought, flooding, hailstorm, windstorm, pest and disease outbreaks, locust, fall armyworm, stem borer, cassava mosaic disease, fire, soil degradation, mechanical failure of equipment. Price risks. The price of produce falls after harvest, input prices rise sharply between planting and harvest. Financial risks. Inability to repay loans, crop failure prevents loan repayment debt cycle. Institutional/policy risks. Government policy changes, sudden ban on inputs, sudden change in export regulations. Human risks. Death or serious illness of the farm operator, theft and vandalism. Social risks. Farmer-herder conflict, community dispute over land. Why insurance is particularly important for farmers. Seasonal cash flow. Farmers invest heavily at planting, buying seeds, fertilizer, labor, and receive income only at harvest. 4 to 6 months later, a crop failure means complete loss of investment with no income to repay. Without insurance, the farmer may lose everything including their future production capacity. Access to credit. Banks are often unwilling to lend to farmers without insurance because the risk of non-repayment due to crop failure is high. Agricultural insurance unlocks credit access. Types of agricultural insurance. Crop insurance covers losses in crop yields or revenue due to adverse weather, pests, or diseases. Types of crop insurance. Indemnity-based. An assessor visits the farm and estimates the loss. Compensation based on actual loss incurred. Expensive to administer. Many small farms across wide areas, prone to moral hazard. Area yield index insurance. If average yield in an area falls below a threshold, all insured farmers in that area receive payment, no individual farm assessment needed, reduces administrative cost. Weather index insurance. Index-based insurance payment is triggered by a weather measurement, rainfall, temperature, from a weather station. If rainfall in the crop season falls below a specified threshold, all insured farmers receive payment, without needing to visit farms. Key advantages: fast payment, no moral hazard, low administration cost. Key limitation: basis risk. The weather at the farmer's field may differ from the weather station. A farm may suffer drought while the station records adequate rain. Livestock insurance covers death of farm animals due to disease, accident, or natural disaster. Important for cattle, poultry, and aquaculture. Challenges: poor livestock records, difficulty valuing individual animals, high moral hazard, deliberate killing. Equipment insurance covers breakdown, theft, or accidental damage to tractors, irrigation pumps, and other farm machinery. Storage insurance covers loss of stored produce due to fire, flooding, or pests. Multi-peril crop insurance, a comprehensive policy covering multiple perils, drought, flood, hail, pest, diseases, for a single premium, complex and expensive to provide. History of agricultural insurance in Nigeria. 1987, Nigerian Agricultural Insurance Corporation, NEC, was established by the federal government under Decree No. 37, NEC was given the mandate to provide insurance cover for agricultural production in Nigeria, products, crop insurance, livestock insurance, aquaculture insurance, farm building and equipment insurance. NEC coverage statistics. As of recent years, only a very small percentage of Nigerian farmers are insured. Uptake has been low due to low awareness, affordability, premiums seem high relative to farmer income, distrust, perception that claims are difficult to obtain, logistics, reaching millions of scattered smallholder farmers. Current initiatives: National Agricultural Insurance Scheme (NEIS), with premium subsidies. Government and some state governments provide premium subsidies to make insurance more affordable. Ministry of Agriculture and Rural Development coordinates. Anchor Borrowers Program (ABP). CBN loans to farmers under this program often have a mandatory insurance component. This has increased farmer insurance uptake since 2015. Private insurance companies. Some private insurers, Leadway, AISCO, etc., now offer agricultural insurance products, but smallholder market remains underdeveloped. Index-based livestock insurance, IBLI, being piloted in some states in northern Nigeria for pastoralists, uses remote sensing data, NDVI, normalized difference vegetation index, from satellites to measure pasture quality. When pasture index falls below threshold, insured herders receive payment. This avoids individual assessment of millions of cattle. Challenges facing agricultural insurance in Nigeria. Smallholder farmer characteristics. Low and irregular income makes premium payment difficult. Illiteracy makes understanding insurance contracts difficult. Smallholder farmers are geographically dispersed, high administrative cost to reach them. BECE risk index insurance mismatch between measured index and actual farm losses. Moral hazard indemnity insurance. Farmers may deliberately allow crops to fail or animals to die, knowing they are insured, difficult to monitor. Adverse selection. Farmers who know their risk is high are more likely to insure. This drives up premiums for the poor. Fraud, inflated claims, fake farm records. Limited data. Accurate historical weather, yield, and livestock data is scarce in Nigeria, essential for designing and pricing insurance products. Low awareness. Most farmers in rural Nigeria are not aware that agricultural insurance exists. Weak institutions. Claims settlement can be slow and opaque, reduces farmer trust. Solutions and innovations. Technology, mobile phones for premium payment and claims notification, remote sensing, satellite imagery, for loss assessment without farm visits, drones for crop monitoring. Group-based insurance, deliver insurance through farmer cooperatives, reduces transaction cost. Public-private partnerships, government subsidies plus private insurer distribution networks. Simple products, weather index insurance is simple enough for low literacy farmers. Extension agents, use existing government agricultural extension network to explain and sell insurance. Government mandate, compulsory insurance for all agricultural loans, like ABP, increases uptake dramatically. Key points: agricultural insurance, financial arrangement where farmers pay premiums to be compensated for farm losses. Agricultural risks, production, drought, pests, diseases, price, financial, human, social. Why insurance matters: protects investment, enables credit access, reduces vulnerability. Types: crop insurance, indemnity-based, area yield index, weather index, livestock insurance, equipment insurance, storage insurance, multi-para. Nigerian context: NEC, established 1987, government program but low uptake. Anchor Borrowers Program increased uptake through compulsory insurance for loans. Weather index insurance, payment triggered by weather measurement, rainfall/temperature from station, no farm visit needed, efficient but has basis risk. Challenges: low awareness, affordability, basis risk, moral hazard, fraud, limited data, illiteracy. Solutions: technology, mobile, satellites, drones, group-based delivery, government subsidy, mandated coverage with loans, extension agents. WAEC questions: define agricultural insurance, state types of agricultural risks, describe types of insurance products, explain weather index insurance, state challenges and solutions, state the role of NEC.